very excited to present on one of my favorite topics. And man, thanks everybody for coming. Thank you, John, for setting this up. I really appreciate you connecting us. I think this topic is always one of those things where people don't have a chance to discuss it openly. And if you ask CPAs, I think you could get some mixed answers. And what I want to do today is present on my experience with real estate and taxes, and how I find real estate to be a very efficient tax minimization investment strategy, and discuss several key points on how I do that, and sort of go into why you should also consider investing in real estate if you haven't already, and if you are, potentially using these strategies. And I wanted this to be a open-ended Q&A session as well. So if you have any questions, please use the Zoom Q&A section to ask questions. I'll get to them as I present. Don't feel free to interrupt me at any point, but we do have a lot of topics here. So, hi everybody. My name is Eng Taing, CEO and founder of Tozy Capital. But I started, in Wharton in economics, and I went to investment banking. And I'll highlight all these myriad of different roles I had, both in the Peace Corps, in analytics, at most recently in corporate America at Apple, leading data science, to highlight the fact that I've been doing all this real estate investing since 2009. And I've been doing it as a side hustle, and now it's more of a main hustle, and taking advantage of all these real estate and tax strategies. I am not a tax professional, but I am somebody who used to pay a lot of taxes, and through these strategies, I'm paying a lot less. So I find like talking to fellow investors is actually one of the best ways to learn tips and tricks on what to do to minimize your strategies, minimize your taxes. A little bit about me. So I first bought my first rental property, triplex, when I was 23. I bought it out of state. I was living in DC. I grew up in California, but I bought it in LA. And I've been buying triplex and fourplex ever since, for almost every year for 7 years, until it didn't make sense anymore. And for me, scaling became more sensible and more economical. And it came with a lot of tax advantages that the smaller units and smaller properties just didn't come with. And so I started investing passively in other people and other deals, getting a lot of great tax benefits from that. And then I started to acquire a lot more bigger commercial, multifamily, senior living deals myself. And I've started to, in the past few years, sort of offer these investments to fellow colleagues and friends and family, mostly in tech. Now we have a lot of investors at Apple, Google, Airbnb, and Facebook and Amazon. So I hope to highlight a lot of strategies today, but I also want to highlight the fact that everyone has a journey, and I think this journey is how I started to learn about these strategies. So for most people, when they think about building wealth, for me at least, it goes in 3 phases. The first phase is you start making money out of college. You want to really save so that you can start investing. And so I started living very frugally. I grew up very poor. I was an immigrant, born in a refugee camp, came here when I was young to America. And I knew how to save. And I used that saving to buy my first triplex. But you can only save so much if you don't make money. And thankfully, we're all in positions that are making quite a bit of money. So you can start making more money and hopefully leverage that money to invest in real estate. But once you start making quite a bit of money and income, you start realizing that your biggest expense in life is taxes. And then you really start thinking about, how do I start reducing my taxes? And that's what I'm going to go through today. So, how to pay less taxes. I think it should be more fairly phrased, how to keep more of your earnings, um, and by minimizing your taxes. Because this is really money that you've made, and these strategies hopefully can help defer and reduce your tax liability. So I like this phrase a lot. When it's about taxes, it's about the facts. You have to rearrange the facts. So it's not about changing any of the facts. It's just about rearranging it in an order that makes sense to the IRS and to the government. And and investing is one of those ways to rearrange that. So what do I mean by rearrange? I think for many of us as employees, uh, our order of operations is we get paid, we pay taxes, and then we spend money um, on our lives. This is a very common thing for every employee, and our general strategy in life is to be more like a business. I think because businesses get paid, they spend money, they have expenses, so they earn revenue, they have expenses, and then they pay taxes on the net profits. And when you think about real estate or any business, real estate is a business. And so you can actually start thinking about how to reduce the net profits by shifting consumption to expenses. And for employees like you guys, a lot of what we try to do and what we put a lot of mind share into is shifting strategies like 401ks, HSA, and FSA. And it's all about shifting spending from post tax to pre tax. Um, and that's a lot of what real estate allows us to do as well. And so, on order of operations, if you can shift your consumption to expenses, you start paying less taxes. And the final category here is, as an investor, you can actually get much more favorable tax strategies by investing, spending money, getting paid on those dividends or income, and then paying taxes. And there's a lot of ways to reduce that altogether as well. And one of the biggest ways to shift things and to reduce your taxes is deferrals. And we all know the benefit of deferrals, hopefully. The biggest thing that we do probably as employees is a 401k or retirement plan. A lot of that is essentially shifting your tax burden from now to later. And in this case, with real estate, a lot of real estate strategies around tax minimization is deferring taxes to the future. And this allows you to invest, grow your wealth, and then finally pay taxes. Although with real estate, there are ways to move that final part as well. So I want to cover today 3 main deferral strategies: depreciation, 1031 exchanges, and opportunity zones. And I think these 3 are a really good introduction to why real estate is such a tax advantage strategy, and why when you talk to other real estate investors or any real estate investor at scale, they're not really worried about their taxable income because they're paying very little. Most of it is because of deferrals. So I want to highlight the value of deferrals. If you can defer paying taxes, say on 100K, and you can grow that and compound that, you're getting a significant return on that 100K in let's say 10 years. You would have to pay, you maybe have to pay that in 10 years now. And that's what essentially what 401k does. And what I want to highlight here is, when you think about investing, you should always think about your opportunity costs. When you think about paying taxes now versus later, you should always think about your opportunity costs. And depreciation allows you to defer taxes. And so, for those who might not know what depreciation is, I'll just go high level. Uh, you can depreciate any productive asset. And in this case, we're talking about real estate and the non-land value of the real estate. So in San Francisco, that might be 50%. In other parts of the country, could be 90 to 95% of the purchase price of that asset. You could buy a home, duplex, a 100-unit apartment building, a senior living community, whatever it is. If it's a productive income-producing asset, and you can do this for data centers, trucks, etc., you can depreciate it and reduce your tax liability by reducing the cost basis of the property. So for $1 million property in San Francisco that has 50% of it as land value, you can't depreciate that, but the other 50% you can depreciate, and you can start taking that as a phantom paper loss every year for 27 and a half years or 39 years, depending on the asset category. Um, the basic premise here is you're taking a loss from the future. You're taking losses and you're pulling it to the present. This is all about time shifting. So when you defer with depreciation, you're able to essentially reduce your income tax with investing in depreciation. So I'll give you a real world example. When I first bought my triplex, I bought it for $126,000. I was making probably $1,200 net income a month. It was a really good deal, uh, but I also had probably a good $300 to $400 of depreciation, and I used that to essentially reduce my taxable income on that depreciation on that property. So I actually didn't have to pay that, but I would have to pay that in the future. But I saved that basically by reducing my tax liability at the top marginal tax rate. And when you pay it in the future, you pay it at a 25% rate. So depreciation is mostly how people get away with having very limited tax liability. And when you think about paying stuff in the future, you got to also consider inflation. Inflation is something that erodes future tax payments. Inflation of the dollar, inflation of loans. I love having lots of loans because if I get a 30-year fixed mortgage, uh, and it's like say it's a $10 million loan or $1 million loan, whatever it is, and if I only pay interest only in 30 years, that loan will be considerably less. Think about how much dollars are deflated or inflated every 10 years. And so at a 2% inflation rate, which is probably less than what it actually is now, it's probably more like 3 to 4%. You're going to be paying less in future. The net effect here is by deferring, you're not only saving taxes now, but you're saving taxes and then you're owing a, a similar amount, the same amount, but at a lower tax rate and then at a lower dollar value because dollars is just worth less in the future. And I'm going through all these concepts very fast, and I'm getting so feel free to just ask questions as I hope you guys are understanding it. If not, I think the whole point here is by investing in real estate, you can get cash and cash returns, but you can also, which gets you money in your bank account. But by using depreciation, you can actually neutralize the taxes on your investment income, and on a property that gets you, let's say, you invest $100,000 and it gets you a 12% cash flow, which admittedly is hard to do in California. You can get potentially 5 years of straight line depreciation at around $12,000 each. And on those $60,000 of cash flow, on that $100,000 invested, you would have saved $22,000 of taxes by not paying them at that moment and paying them in the future. So for a lot of my investments nowadays, almost all of them are neutralized on the cash flow position, but with depreciation. So for anybody who owns any real estate, income producing real estate, you should really consider how depreciation is affecting your taxable income. That allows you to essentially get a 12% cash flow on a return that's tax deferred, which is comparable to a 17% return. So if you think about real estate income versus dividend income or active income, real estate income is oftentimes way more tax advantage. And this is true when you invest in companies like Tozy Capital, company I run, where you can invest $100,000, you get 12%, and you get $12,000, $1,000 a month in your bank account. But through the power of depreciation and passing that through to investors, we can reduce your taxable income to zero for that property. So there are many levers for depreciation. And one of the things that people talk about when they try to acquire any property is, I want to put more money down. And if you're not investing for cash flow, this is probably necessary. But by putting less money down, you actually get less depreciation, because whatever property you're buying, it's going to generate the same amount of depreciation. And the bank does not share in depreciation benefits. So if you put in 100% cash, you would get the same amount of depreciation if you put in 20% cash and 80% loan. But in the 20% cash, 80% loan situation, or an 80% loan to value, you would essentially get 5 times the amount of depreciation relative to the dollar value you put in. So this is why I love investing for cash flow as well, because when you invest for cash flow and not appreciation, although I don't think those two are mutually exclusive, because I've always invested for cash flow and they've always appreciated. But with the intention to invest for cash flow, it allows you to get higher leverage typically, because banks want to see that fact that that the property can pay for itself. And by getting higher leverage, you can get more depreciation to your own personal taxes, or to the real estate taxes. So by going lower on leverage, you get less depreciation. And by buying in higher land value areas, if the land value is 20% of the property, which is not, it's not something where you can find in California, or at least in the parts of California where we want to live. If you're buying something where 40% land value, then the depreciable assets is now cut in half, or actually the not the level, and so you get less depreciation. So when I think about buying properties overall, I always consider buying for cash flow. I always consider buying higher leverage, and I always consider where I'm buying. And when I buy in lower land value states, I'm able to capture more of that investment basis, the more that investment costs as depreciation. That allows me to get a higher tax write-off. And so even in some cases, I've made close to 12 to 15% cash and cash, meaning I'm putting $100,000 down. I'm getting $12,000 to $15,000 a year on my investment, and I'm not paying any taxes on it. In fact, I'm reporting a net loss because of these factors of depreciation and land and buying in these places. So depreciation, a great way to essentially defer taxes. It essentially lowers your cost basis. And so what can you depreciate? You can depreciate any buildings rent for income. You can depreciate parts of your house if you're renting it out. It's a little more complicated. You can depreciate an ADU if you have one, accessory dwelling unit, and an in-law suite. You can depreciate vehicles. So if you buy Tesla Model X or any vehicle that's 6,000 pounds or more, you can take 100% bonus depreciation then. If you look at how Amazon pays very little taxes in 2019, around 75% of the tax mitigation strategy, it comes from depreciation. They depreciate almost anything and everything. They depreciate all their delivery trucks, all their data centers, all their real estate. But you can't depreciate personal property because that's not an income producing property. You can't depreciate land. You can't depreciate collectibles and stocks. So just be mindful of what you can depreciate and what you cannot depreciate. By using depreciation carefully and effectively, you can reduce your taxable income a lot. And through the 2017 Tax Jobs Act, you can actually take a bonus depreciation, which essentially allows you to take a lot of the depreciation that would be given over 27 and a half years or 39 years, and taking maybe 20 to 30% of it in the first year. The net effect for an investor is you can put in $100,000 into an investment and get 50 to 60 to maybe even 80% of that investment basis as a first year loss. So in that case, you're actually having so many, you're actually creating more losses that allows you to offset other income, other real estate income, other passive income. Uh, Tatiana asks, can you tell a few examples of how to depreciate buildings you rent? In every case where you have a rental income, you're filing a Schedule D, I believe, or C, one of those. Not CPA, but I file that almost every year. Every year, you have to take depreciation into account, and so if you're not, the government is already taking that into account for you. Now, it's usually being recaptured, meaning that if you essentially bought a property for $1 million, and and you took $20,000 worth of depreciation over a 10-year period, now you reduce the cost basis to $800,000. So when you sell it for $1.2 million, instead of paying taxes on $200,000 of gains, you would pay taxes on $400,000 of gains. So how you actually take the depreciation, essentially you just tell your CPA they should do it for you. Most tax software does it automatically as well. You should have a depreciation amortization schedule that allows you to essentially understand the depreciable assets. So essentially the cost basis minus the land value, divided by 27 and a half years for residential property, meaning multifamily, duplex, condos, etc., and 39 years for commercial property. So depreciation is great and allows you essentially to not, for the most part, for at least my examples, to not pay taxes on the cash flow of real estate. And for me, I've always invested for cash flow. I invest for, having predictable double-digit, typically, cash flow on my investments every year. And by being able to take that cash flow and then invest it in other things on essentially a tax-deferred rate, I'm able to grow my wealth and compound and snowball faster. And so for deferrals, ultimately, the tax bill gets due because it's a deferral, not an elimination. But what you can also do, you can combine that with 1031 exchanges, and you can defer it even further. When you sell a property, you can defer it by 1031 exchanging again. So any gains you have, which includes depreciation recapture or capital gains on sale of property, you can defer that further and get more, essentially more time to not pay taxes. So what is a 1031 exchange? With a 1031 exchange, essentially when you have income producing property, you can sell it, and then within 45 days, identify 3 properties, and then within 180 days, close on the second one. And the situation, essentially a scenario here would be if I bought a property for $500,000, it's now appreciated to $1 million. I don't want to pay taxes on that $500,000 capital gains. I can 1031 exchange it, essentially sell it, and then buy another $1 million or $2 million property. It just has to be a bigger property than what I'm 1031 exchanging into, and essentially keep deferring the taxes on it by essentially migrating the cost basis. It's a bit tricky to explain and highlight, but essentially 1031 exchanges happen all the time. And it's a crux of essentially how real estate investors keep deferring these deferral strategies. And with 1031 exchanges, the great thing with depreciation and tender exchange is that they go together very well. When you invest in properties, you cash flow, you get cash flow tax free typically or tax deferred. You then can tender exchange it into another property. And then when you get more cash flow, you get more depreciation. You tend to exchange that to more property. And there's little known rule where when you pass away, hopefully pass away, you have heirs, you owe all this insane tax bill because you bought $500,000 and now you exchange it to $1,000,000, exchange it for $2,000,000, exchange $10,000,000, over 30 years or whatever it is, or however long you have it, and you keep deferring the taxes, right? At that point, your cost basis is like zero, and you owe so many taxes that if you ever sold it without an exchange, you would have to pay a large tax liability. But in a scenario where you pass away and all these properties, their cost basis gets stepped up to fair market value. The biggest thing here is no one gets left holding the bag for taxes. Your heirs essentially can sell it at the fair market value and pay no taxes because their cost basis is what they received it at. And all those deferrals that you've taken the whole time on the cash flow and the tender exchanges and the capital gains gets completely eliminated. So no one gets paid, no one had to pay taxes. So deferral strategy turns into elimination strategy. I'm going to pause to answer a few questions. Yan Feng asks, with the house appreciation post-pandemic, it's harder and harder to find house investment opportunities with double-digit cash flow gains. Yes, this is a great comment. I think it's been very hard to find cash flowing properties in California since 2015. And when I think about investing for properties, if I invest for just appreciation, meaning there's no cash flow, depreciation doesn't really help. Depreciation is really a deferral of cash flow. But if you have no cash flow, you're not deferring anything. And so it's a neutral event. There's no benefit to depreciation. So that's why I invest in outside California. And I invest in places so you have to be familiar, you have to get comfortable with investing outside. You could invest with a company like ours, and you're essentially co-investing in a much larger property, which has great economies of scale, lower variable costs, better potential income because we're professional operators, and get all the same tax benefits of owning it directly without any of the liabilities. You don't sign any paperwork, sign any debt, etc. So sort of the benefit. And there's lots of companies like ours, but that's one way to do it. I have another question. I have a silly question. Why do I need to sell old houses and do tender exchange rather than buying more new houses? So you don't have to sell ever if you don't want to. The other way to keep pulling out money from a property is to do a cash out refinance. Remember, these loans that you could be getting essentially a 3 to 4% loan. If you can earn 10 to 12%, it's a great use of capital optimization strategy. Borrowing at 3, investing at 12, nets you 9% on every dollar you borrow. But if you like the property and you're managing it well and you don't have any issues with it, there's no need to sell it but you should always consider when you move from property to property. And I think for most of you guys, the biggest open question is, should I sell my property that I'm moving from? And if you don't need the cash, it's a serious consideration. And the consideration should be, would I buy that property that I'm leaving as an investment property right now? And if you're living in California, in the Bay Area, where I used to live, and I sold a property a year ago, actually, I thought, no, I wouldn't be making cash flow in it. I can use that money better elsewhere. And so I sold it and tender exchange it into another property that I could make better returns on. And I didn't want to pay taxes on those on that capital gains. And for those people who don't want to manage properties, I think tender exchanges into properties that's harder to manage but has appreciated into something else is a really good strategy overall. Another person asked, directly buying more new houses when cash I currently have. For me, I think it's beneficial to buy more houses rather than sell old ones, since old one normally has better cash flow. So I think it's generally the fact that when you think about cash flow, you think about how much how much you're netting every month, but you should really think about how much percentage you're actually getting. Because if you're netting, if you're netting $1,000 every month, but your investment basis is $1 million, then you're making less. You're making 1% a year annually. That's not, and that's not a great investment term. You could be making $10,000 a month. So I think you should always consider what what's the opportunity cost. Because that's, when we make decisions on not doing something, it's a decision of it's effectively doing it again at that current market value, because you could be selling it, get that capital, and invest in something that's potentially better and higher productive. Um, Evan asks, is there a risk that laws will change, leaving you unable to defer holding the bag? They have tried to take out tender exchanges for the longest time, and they've effectively failed all the times. This is something I fundamentally believe, that people in power will always try to benefit themselves, and they will always, and the people in power, almost all of them are real estate investors. Almost all of them own real estate, and almost all of them don't want to pay taxes. And I like to just be on the side of self-interest of people, people in power. Uh, and so, in the latest infrastructure bill that Biden and the Republicans sort of came to a consensus on, potentially, they've removed almost all the capital gains stuff that Democrats wanted, and they removed the tender exchange stuff. So those things aren't, from every CPA I talked to, those things are likely not passing this year. But yes, things change and evolve, and new things come up. So one of the new things that come up is opportunity zones. And an opportunity zone is a really great new thing that came up in 2017. So a little bit of history on opportunity zones. Sean Parker, ex-president of Facebook and founder of Napster, was instrumental in lobbying. And I have a lot of lobbyist friends nowadays. And they told me a story of how he put in $1 million. He organized around $16 million of lobbying to insert this in the Trump tax cuts. And this was supposed to bring investments into underserved communities. But the net effect is it allows Silicon Valley folks who have lots of capital gains to essentially reduce, defer, and eliminate those capital gains. And so John Parker, through the miracle of money, he looks like this now. And this was a Recode article from 2 years ago. So what is an opportunity zone, and why should you invest in it? So opportunity zones are, located across America, and it's dictated by state. It's a very political thing. There are opportunity zones in downtown San Jose. There's opportunity zones near Seattle. There's opportunity zones in very rich areas and very poor areas. It's supposed to be meant to really improve areas where that needs a little bit more improvement. But the net effect is that the local governments have decided, and that's not always the case. And there's really three main benefits of investing in opportunity zones. And the biggest benefit that I feel is a tax deferral. So if you've recently sold Airbnb stock, or have a lot of capital gains that you typically pay taxes on, what you can do is invest those capital gains portion, whether it's short term or long term, and invest it before by the end of this year, for example, and get a 5-year deferral up until December 31st, 2026. So you don't have to pay the capital gains portion now, and you don't have to pay taxes on it. So you have $100,000 of capital gains, you would pay 24% federal, and if you're a high income earner, and essentially you pay that 24% ish in 5 years, 5.5, and And then in 5.5 years, you actually reduce that by 10%. So you actually, whatever you owe now, you would owe that in the future. You can grow that bigger capital gains amount, bigger investment basis, and grow, compound it, and earn on that basis instead of earning on a smaller basis. And you're essentially reducing it by 10% in 5 years. So you, and I'll illustrate this in a few slides. And then if you hold for 10 years, and this is why opportunity zones are all typically 10-year investments. If you hold it for 10 years and you sell that property, and that's why mostly opportunity zones are real estate, it doesn't have to be, all future capital gains, meaning that any appreciation that the property has, any depreciation recapture that you took, which is a big portion of capital gains, gets completely eliminated. So you don't even have to do a tender exchange in 10 years. So what it's eligible, we have investors and we have an opportunity zone fund as well, but we have investors that invested with lots of GameStop earnings, lots of Tesla earnings, lots of Airbnb earnings from stocks, short-term and long-term if they're traders. Short-term is even better way because you're deferring more taxes. You can defer capital gains from sale of business and real estate. Although you also have tender exchanges for real estate, although sometimes an opportunity zone is a better alternative to a tender exchange because it gives you more flexibility. So why should you invest in an opportunity zone? I want to highlight just real quick a scenario of someone who has sort of some RSUs in 2019, potentially you guys, and then invests into an IPO in 2021. Whenever, and you've gotten $100,000 of gains. So the cost basis, don't worry about that. You don't have to pay taxes on the cost basis, but the profits you have to pay taxes on, potentially. So those gains, investor A, they take those gains and they invest it into stock market again. It's a sensible strategy, or they invest it into non-operating zone real estate. But on just by taking that gain, selling it, and then putting into net investment, you had to pay taxes. And I'm going to assume this is long-term capital gains. Am I talking about federal at this point? So you have to pay, and depending on the tax bracket, it's around 23 and 8.8% because 20% long-term capital gains, 15 or 20. Then you have Obamacare at 3.8. So 24K. So you invest on a 76K of the 100K gains portion. And let's say you hold it for 10 years. You compound that from 15% every year, which is above average of the market, but could happen depending on where you invest in it. And that 76K turns into 308K. And then you sell it in 10 years because you want that capital eventually. You want to have it for potentially passive income or real estate investing. And you get left with 253K. So from that 100K, you get a 2.5x ROI in 10 years. Pretty good. And I think most of us do this on occasions and have done this in the past. But with an opportunity zone, it allows us to defer the taxes and instead of investing on a 76K, and if you're investing short-term capital gains, you're investing a lot, you're saving a lot more taxes now. You're deferring that, you're paying that in end of 2026 or really 2027 tax year. You're paying that taxes, that 24K, but you're paying 10% less because this cost basis gets stepped up by 10%. The net effect is that you pay 10% less in at that time. You still grow at 15%, because I'm using the same analogy, but it's an opportunity zone, and it grows because it's much bigger starting basis. You're able to grow to a much bigger amount at the end of 10 years, and because you hold for 10 years, you don't have to pay taxes on that at all. So it's a 3.8x multiple versus 2.5x, or a 50% better return given the same return parameters, just by not having to pay taxes going in, or deferring taxes going in and not having to pay taxes going out, like a 401k and a Roth IRA combined. Best of both worlds. I'm going to pause to answer a few questions. Um, John Romano asks, I think long-term capital gains tax would be more like 24% plus 10% for California residents. So unfortunately, John, um, California has not decided to comply with opportunity zones. California does not comply with a lot of things. I pay very little in federal taxes, but I pay a lot in my California taxes still. So you still owe the California taxes. As of now, they could change that in the future. California is one of the few states that does not comply. So another person asked, could you repeat one more time why doesn't investor B pay taxes after selling? Because on opportunity zones, when you sell the property or the investment after 10 years, all future capital gains, not the ones you owe because you have paid that in the mid in end of 2026, all future capital gains gets completely eliminated. And remember, if you're doing real estate in general, there's tender exchanges you could do, but that's that is more complicated, and you have to do and you have to identify a property and whatnot, and you have to reinvest it. In this case, all future capital gains gets completely eliminated, so you don't have to pay taxes at all on those capital gains. CC asks, I own land in an opportunity zone. Can I build a rented property on it and invest for those type of cap gain savings? Yes. So if you own property in an opportunity zone, you can actually build on it. Um, uh, then the rules are a bit harder, and I think the challenge here is you have to put 100% capital improvement. So if it's just raw land and you just build anything, that's going to be that. If you're renovating or you're developing something else, you just got to put 100% capital improvement, meaning that if the land is worth $250,000 and the property is worth $250,000, you have to put another $250,000 into it to qualify. This is why most people invest in funds, and funds can typically get the same type of returns. But yes, if you own property or you want to buy property in an operating zone, you can almost do the same thing. Obviously, scale helps here, so it really depends. Another person asked, are you saying that in year 5, even if I don't sell the property, I pay taxes at that point? Yes, it's a deferral of the current taxes that you owe. And that December 31st, 2026 date is hard coded. So you would have to pay taxes at that time, although it's still unclear exactly when. I think it's likely going to be in 2027. Based on the latest IRS rulings, and they change things all the time. But you're essentially only deferring and then reducing it by 10% for 5.5 years. And then all future capital gains and the depreciation recapture that you take in, meaning that if you've gotten cash flow from the real estate, you would typically not have to pay any taxes because depreciation neutralizes that cash flow from the real estate. You can do bonus depreciation, you can do everything else that real estate allows you to do. But then you have a big depreciation recapture, which is classified as capital gains, and you don't have to pay that at all at end of year 10 when you sell. So never asked, can you always hold for 10 years for option zone investments? Would projects stop or get sold before that timeline? You don't always have to hold for 10-year for option zones. If you sell and then you return your capital, then you gotta pay taxes. But there's also another law where essentially when you sell a property, here I'm getting a little more technical. You have a QOZF, qualified option zone fund, that invests in QOZB, qualified option zone business, typically real estate. You can sell that. That fund goes to the F, the fund, and then you have 12 months to then buy another property or invest into another OZ, and essentially transfer that 10-year benefit over, so you don't have to pay taxes. Nitin asks, how do I decide which option zone fund to invest in? There's so many out there. That's a good point. There are a lot of investments out there. I think you should really consider, hopefully you consider us. We have option zone funds. But I think you should consider what type of returns you can get, and how you think this property would fair in 10 years because these are 10-year investments. So for us, we invest in senior living communities. We're building one in Jacksonville, Florida, and uh, Jonathan investing with us, and we're essentially, it's a great 10-year horizon because these investments provide really strong, predictable cash flow and great tailwinds with the aging population. We're providing 12% cash and cash returns to investors, and there's an option for 16% as well. But those are, we've gotten nearly 120 investors so far with us on this opportunity zone investment. And I would highly recommend to consider an opportunity zone if you sold any stocks, because it's the first time you can now leverage something like this. You have 180 days from when you sell to when you invest. So you have 6 months, and then to place your capital in the fund, and then the 10-year clock starts ticking. So anytime you're investing in a publicly listed company and other, bigger funds, I think you also have to consider significant overhead. Um, there's pros and cons to investing in bigger public traded companies. They have corporate overhead. In REITs, you don't get the same tax benefits on depreciation. It's because it's not a limited partnership. You're not getting the same direct benefits. What is the average annual return for operating zones? In general, real estate leverage, private illiquid real estate is oftentimes better than the stock market because it's leverage and it's illiquid. So there's asymmetric benefits. I've almost always returned 12 to 16% on all my personal investments, and that has outperformed the market when you consider the fact that I don't pay any taxes on that. And obviously, if you're investing in just tech industry, there's always different funds and different equities that can outperform anything. How do I find opportunities to invest in? My property agents normally don't have those resources. Yes, it's funds that you want to invest in typically because you probably wouldn't have a big enough capital gains portion to then buy it straight yourself. And it probably wouldn't make sense to build something in California if you live in California. But you can go to my website, or you can Google it as well. Do I have tax benefits as well if I bought the options on funds? Yes. So options on funds have all the same benefits. All our investments have all the same benefits because essentially you're co-investing with us. I'm buying a property, I'm building it, you're being a partner on it. You don't have to do anything. You get all the same benefits, same returns, and you don't lift a finger. That's sort of the benefit. And it's what I started to do a little bit more when I had less time, and now I do this full time for our investors. So there's a lot of shifting and rearranging that, we have 8 minutes left. I want to go real quick. That you can do when you're, rearranging facts. You can shifting from active to passive, from long-term, short-term to Airbnb, which is active income, to renter income by subleasing yourself out. You can pay your kids. This is something that if you own a business or you should always consider doing. You're essentially paying them $12,000. You don't have to pay taxes on $12,000. Now your taxes go down by $12,000. Save money there. You can shift from now to later, option zones, 401ks. You can shift from consumption to expenses. You can buy a Tesla Model X or anything that's 6,000 pounds or more and get a deduction on that if you own a business, a home gym, etc. And you're shifting from after tax to pre-tax. And if you're doing all these things, you can also, for someone like me, you can also become a real estate professional. And the benefit here is if you qualify to this flow chart, 750 hours, which if you're an Airbnb employee, you're not going to be able to qualify. But you're essentially turning all that passive loss with the passive income into active loss. And why does this matter? It matters because if you have a huge active income, W-2, and you are able to accumulate so much depreciation, you can now take that against your active income and reduce your tax liability. And the best way to do this, if you can't be a real estate professional yourself, which is very hard and nearly impossible if you're working full time in any other job, is to be married to one. And if your spouse is, currently unemployed or doesn't is underemployed, they could be a real estate professional. Doesn't mean you have to be a real estate agent. There's many ways to qualify. It's a little bit more burdensome, but it allows you to essentially take all the strategies I've talked about and reduce your taxable income. And I want to highlight one last strategy that I think, if you're not considering being a real estate professional, you're not considering doing all this other real estate stuff, this is a quick win if you have a big tax liability. And this is something that Donald Trump does a lot, and lots of other very wealthy people. And I've only started to realize this once I started to um, talk to other wealthy people who invest and realize, how do you pay very little taxes? And the big thing here is, if you invest in a land conservation easement, and I don't have much time, so I'm going to just blow by what this is. And it's a fund still, right? So if you invest in land conservation easement, the net effect to an investor is a charitable deduction that gives you a huge multiplier. So if you have a $500,000 income, you can take half of that AGI and be reduced with a land conservation easement. So if you invested 50K into, or contributed 50K into a land conservation easement, you can get a 250K tax write-off that applies for both California and federal. So if you live in California, this is a huge benefit. And take out the top line marginal tax rate, and essentially pay very little taxes. So that $50,000 turns into a $125,000 tax benefit, netting you 25K tax break. Consider doing this. There's a little bit more risk to it from a tax perspective, so do it with a really good team. I'm working with you. I can refer. Yes. I'm gonna blow through this, and I want to end up with this. 90% of all millionaires become so through owning real estate, and this is said by Andrew Carnegie when millionaires was a big deal. Um, uh, and I really fundamentally believe, all my corporate earnings have really been funneled into real estate and allowed me to be financially free at 35 when I retired, and then kind of started Sozi Capital. But um, I retired because my passive income through my real estate started to be more than my active income through Apple, which is a very high paying job as well. And I started to make, and that passive income was almost nearly tax free. Another quote here by Donald Trump that makes you smart during the presidential debates, first one with Hillary Clinton, when she asks, so, you don't pay in taxes. And this is how my one of my previous taxes looked like, where I essentially took all these strategies, I applied it against my W-2 income of $500,000 and paid zero in federal taxes. So you can, if anybody wants to reach out to me, we're gonna have a few minutes left. I'll stay on. If anyone have any questions, I'm always happy to answer questions. If anyone wants to invest or reach out, ask any questions. I love talking about taxes. So I share my contact on chat as well as here. ZT asks, how are you getting paid if we invest with you? Essentially, we are essentially the property managers on the property. So we get paid from managing the property. Plus, I'm an investor myself. So I really want to be able to buy bigger stuff and invest in bigger stuff, because there's so many economies of scale. When you buy bigger, if you buy a 100-unit property versus a 3-unit property, your standard deviation of outcomes becomes so much less. It's so much more predictable. You can have one tenant go bad in a 3-unit property, you have 33% vacancy. That kills your cash flow. That generally doesn't happen. A third doesn't go away in 100-unit property. You also have better, lower variable costs overall. So, and the loans on a $20 million property, it's so much easier and so much cheaper and better than on a $1 million property. It's ridiculous. People want to give you big checks. The government does, and the banking system does. Could you introduce a bit more about opportunities and funds you mentioned? Yes. So feel free to reach out to me on opportunity zones. I will link the opportunity zone investment that we have available um, in the chat as well, if I have it right now. But one of the things that I want to highlight is it's only until the end of this year that you get the 10% benefit for opportunity investing because it's hard coded. I'm linking the opportunity zone benefit here. Opportunity zone fund. So our fund offers 12 to 16% returns annualized, paid monthly. So if anybody's interested, that option is there. We also help with land conservation easements. We also help with on a non-OZ, non-land conservation easement stuff, where we have typically 3-year investments or 3 to 5-year investments. An investor would typically get cash flow 10 to 12 to 14%, often 12%, and they get that tax free because you would get that in your bank account every month typically, and then you get a K1 and the beginning of the following year for the tax year and report a negative number or a zero, and any negative number can be carried forward to the future. So that allows you to essentially reduce your tax liability, pay very little taxes on all the other passive income, compound and grow it, and by doing all these other strategies to keep deferring it to the future, so that you essentially never have to pay taxes. And for the foreseeable future, I will likely not be paying any taxes on my federal income. Unfortunately, I live in California. I'm not going to move because I love the food here, but that's something that I'm happy to pay some taxes on. Will you be sharing the recording and presentation? Yes, I will be sharing the recording to John, and hopefully he'll be sharing with you guys. Thanks everybody. And we're at 1:00, and let's see if anyone have any other questions. Yep, no. Thanks everybody, and I appreciate everyone coming on Friday. And have a good weekend. Let me know if you guys have any other questions. Reach out to me at eng@tozicap.com. It's in the chat, and I will be sharing this presentation with John. Thank you. John says I'll be sharing recording in financial markets Slack channel. Thanks, John.